a good one for you. We're going to be going over financial statements. We're going to be looking in terms of this training into three parts for you. First part that we have is going to focus on foundational elements. Second part of this training will be a deep dive into each of the financial statements. What is the purpose of those particular statements? Lastly, we will go into as a segment that we call Money in Motion. This is really designed to talk to you all about best practices to putting that data into use. I'm always a sucker for a quote, and I thought
What
this was a
happened to
pretty
it?
good one, which is that with my mind on my money and my money on my mind. And for I know members of the board who are joining us tonight, certainly one of the paramount aspects of what you all do and the work that you have is related to the financial health of the association and making sure that you understand the dollars and cents when it comes to the performance of the association to help drive general decisions for you all, I know is absolutely paramount. So, as I mentioned tonight, our goal is to help you get structured, help you have a good understanding of what those financial statements are and how you can use them in guiding yourself through those particular decisions. So, let us get started. As I mentioned, we want to start with some foundational elements. These items are to give you kind of a baseline understanding of the purpose, how these statements are made, a little bit of the why and the technical aspect of producing financial statements. I'm going to leave this section and ask Michelle to jump in with a little bit of color commentary as we go through. First and foremost, the basis of everything when it comes to your financial statements is structured off of the accounting method. We have multiple clients on tonight, and each of you, when you negotiated your contract with Majerle Management, made a couple of choices. You made a choice regarding how many meetings you want. You made a choice regarding how many site visits you were looking for. And one of the other elements you made a choice in was regarding the accounting method used for the association's financial statements. And those financial methods are really broken down into three recognized categories. First and foremost is accrual. This is when we have revenues or expenses that are recorded when a transaction occurs rather when a payment is received or made. Revenues and expenses should be recognized in the same period. So what does that particularly mean? That means that if you have, let's say, a landscape contract where you are making equal installments of $1,000 a month, regardless of whether we pay two of those invoices, let's say in the same month, we get one particular invoice that shows up mid-month, and then we get an early invoice for the following month. What you're going to see is that regardless of if we paid those in the same period, which is the month that we're looking at, you're only going to see one of those transactions occurs. And the goal of that is to organize the financial statements in a way that your transactions are matching up when the expense or the revenue is incurred or received, not necessarily when it's paid out, which keeps the books for some associations a bit cleaner. Michelle, any comment on that to add in?
Oh, no, I think you summed it up well.
Appreciate that. Next for you all is going to be cash. Now, a majority of our homeowners associations use cash. And the reason being is that you find that accrual is really used for much larger organizations and businesses that are keeping track, like I said, of a litany of financial statements. Homeowners associations, not that necessarily complicated when it comes to the average that we're talking about. So most associations may use cash-based accounting. And that is when revenues are recognized when cash is received and expenses are recorded when cash is paid out. Let's go back to the landscaping.
Hey, Jason.
Yes, ma'am.
Sorry to interrupt you, but in the chat, there's quite a few people that's saying it's hard to hear you and that you're not clear. You sound clear and loud to me, but I guess to others, it's hard to hear you.
All right, how about, let me do a test. How about now?
I can hear you fine, Jason.
I appreciate that.
Okay. All right. So, okay. Sorry about that. I didn't mean to interrupt you.
No, that's fine. I
Um,
appreciate that. So let me go back, and if for some reason we're still having some audio trouble, Michelle, I might turn that over to you. So going back to where I was discussing, we have revenues. Revenues are we have cash basis where cash is cash basis where revenues are recognized when cash is received and expenses are recorded when cash is paid. So going back to our example that we had for the landscaping contract, let's use that example again. We had a situation where a invoice for the landscape was paid in that same month. What you would find with those particular financial statements is you're going to see two transactions hit the book for that particular period. So you're going to see your budgeted amount may have been $1,000 and you end up seeing $2,000. The following month, since we made that payment in the same month, you're going to see $0. And that's because these expenses are happening live. It's really the ticker tape, if you will, of all of the financial transactions that you have being recorded at the time. And in the end, the goal, and Michelle will talk about a little bit more on the purpose of interim statements, in the end, since all of these payments are equal in their amounts, you will find that these payments will balance out in the end of the year, which is why the December financial statements are absolutely critical. Last is the hybrid, which is modified accrual. This combines the accrual basis with respect to your revenues typically and your expenses being done in cash basis. And part of that is the organization that takes place in terms of ensuring that for all of your associations, the assessments are really not negotiable. They are a requirement that the membership pays to the association. So in theory, we can record all of those items and, and note them as being collected and balance that out on your balance sheet in terms of, I have some clients who will say, oh, well, how do we know if we collected all the money when it looks like it's always the same amount? That's where your balance sheet comes into play in a segment under your liabilities, which is accounts receivable. Excuse me, under your assets, which is accounts receivable. That's going to be the amount where you can take a look at how much money is outstanding to the association that certainly is required to be paid, but maybe has not been received from those homeowners. Michelle, any comments on the general accounting methods?
I would just say, you know, I don't want to say that one is better than the other. I think for community associations, sometimes cash is a little bit easier to understand. And when you're looking at it, because accrual tends to, I don't want to say misguide you, but sometimes, you're seeing the revenue that was incurred in that month, but that's not necessarily how much money you collected. And the amount of expenses that you're seeing on the P&L is not necessarily what you paid out. So cash sometimes tends to be a little bit easier to look at because then you really know what was brought in and what was paid out. But both methods, you're going to have supplemental reports that are going to help you to understand really what the position is of the association at that time.
Michelle, appreciate that.
Excuse
All right.
me, Jason. May I ask a question?
We're going to hold questions, my friend, until the very end. We have a whole segment for that, okay?
All right, that's fine.
Thank you. So let's take a little bit of a segue into an aspect of fund accounting. And Michelle, just real quick, how's the audio coming on your end?
To me, it sounds fine.
Excellent. So let's talk about fund accounting. So as you all may have noticed on your balance sheets and certainly your income and expense statements, you see, if you will, two different areas. You have the operating account in one particular column on the balance sheet and your operating expenses, and then you'll have a second section for your reserves. You will also notice in your income and expense statements a separate set of ledger items related to reserve transactions. And the reason is that here at Majerle Management, we utilize a method of fund accounting. And the definition of that is that it is an accounting method that organizes an association's financials by purpose. So separating out reserves, special assessments, and operating. rather than pooling all of that together into one account, or certainly blending those items together. Its purpose is to provide a little bit more of transparency for how charges are going in and out, but also uh, going into some IRS regulations regarding what the IRS would tag as operating expenses versus reserves. Michelle, want to get some comments from you on the reserve fund and what that also means for our clients.
The reserve funds, essentially are just there to fund the replacement and repair of any capital expenses within the property. And you have to be very careful with those. As you mentioned, you don't want to mix them. Um, on very rare occasions, there may be a loan from the reserve account to cover operating expenses until a special assessment can be created. But really, those reserve funds are there, and you legally have to fund those reserve accounts. Um, just to make sure that the community is safeguarded to cover the expenses covered in the reserve fund. Um, sometimes it seems like just an added expense, but it really is very, very necessary for the health of your community.
Appreciate that, Michelle. We can point on that as we get to the deep dive of the individual financial statements. However, I think the main takeaway is that what you might find in terms of, I've worked for some other management companies, and some of the accounting methods, which are all certainly correct, you may see a transfer from reserves, items being placed in the operating account to then cut a check in order to make that particular payment. So the goal behind fund accounting is a little bit deeper in terms of reserve studies, but really it gets into that income and expense statement side so you can clearly see what exactly you've been paying for, what are those items that are coming due, where money has moved. So it's just an extra level of transparency for you all and a little bit more clarification regarding, you have reserve contributions, which is really just the savings account and adding to that. But this is tracking the money in terms of, okay, we did a capital project. We have paid that out of our reserve account. We can look back and see how those funds were distributed out. And I will tell you this, it'll make a little bit more sense when you go through all the financial statements to see how that's unified together, especially when it comes to the balance sheet side and income and expense side. So more to come on that. Let's talk a little bit about roles. And I want to start with management's role, and then we can dive a little bit into the board's role when it comes to financial statements. So for you all, the roles that management plays for producing your financials, serving as your accounting services, if you will, can be found typically in section 2.2 of the service agreement. And those deliverables that we have are the following: reserve owner payments and processing your deposits, enable payments by ACH, debit, e-check, maintaining owner balances, applying late charges and applicable interest that your your collections policy may or may not have, reconciling bank statements. We coordinate with your CPA for audit and tax prep, issue your monthly financial reports, issue welcome packages to your new homeowners, and draft your budget and attend the budget meeting. Let me dive into some particular contract provisions that I think would be helpful in terms of how we meet those charges and also management in motion, if you will, what we're doing on a daily basis for you. So first item up is under section 2.23 under maintain bank accounts. This is where you will find the spending authority that management has contracted for incurring expenses, usually one-time expenses on your behalf. So in this particular example, this dollar amount is $3,000 for this client. And the goal here is that our community managers are looking at your budget. They are also trying to action items quickly for you all. So if you have a situation where there's a plumbing leak they need to get a plumber out to address it, not necessarily a casualty loss situation, but certainly something that needs to be repaired. This provision in the contract would allow them to exercise that authority to act on your behalf, call the plumber, incur the charge for the plumber coming out and fix the problem. And the key here is that it's a dollar amount without prior board consent. I would tell you all that this is something that is a flavor of every association. I have no hard feelings where associations either say, I want to increase that or lower that. It's really your level of comfort. The issue becomes for most associations is that unless they have designated to a particular officer, let's say the president or the treasurer in some cases, the ability to expense funds on behalf of the association, you would typically need to get unanimous consent for any board action outside of a meeting. And that's a little bit hard to do if you have an emergency situation. Our goal is certainly to adhere to your budget, address items, stay within the confines of the spending that you've outlined. But certainly when there are threats to life and property, that might not be achievable, or we may need to act in order to prevent a larger expense. But that's a key provision for you all to understand what authority we have to spend money on your behalf, as well as the methodology that we teach our managers in acting on that. Another big item under expenditures, section 2.6 talks about emergency situations. In your contracts, management is authorized without prior consent to expense funds as necessary in emergency situations that may involve a danger to life or property or may threaten the suspension of any necessary services to the community. What does that mean in practice? What that means in practice is that management through this provision has the ability to incur a mitigation contractor on your behalf. Now, in most situations, that's going to be at no cost to the association outside of the deductible in a classic insurance claim situation. But this provision allows us to separate that spending out from normal operations. And at 1 o'clock in the morning, when we hear that there is a sprinkler that has busted and we need to bring out professionals in order to address that, we have the authority necessary to incur that cost on your behalf, and then we would work in with you all on an insurance claim. Last item for you all is regarding the budget. And in our contract section 2.1, in terms of the managing the budget process, we will prepare an annual budget for you all at least 60 days prior to the date of the notice of the board meeting at which it is to be considered and deliver a copy of that proposed budget to the board. That, for our Maryland-based communities that are on the call, gets into the process outlined in the Maryland Condo and HOA Act with respect to the association giving notice of its proposed budget, which is typically the last step before you finalize it. You need to send that out 30 days in advance to the members and say, hey, here's the proposed budget. This is most likely what we're going to actually pass, and give those individuals a heads up of the meeting that's going to occur. So we work 60 days from that. Typically, we'll look to get you something around Labor Day. Certainly don't want to ruin your holiday. But for us, we're starting budget process typically in, I would say, May, to get those produced on the accounting side, all of the templates that go in to creating those budgets, setting those up, importing prior data for you all. We're releasing those to the managers roughly in early to mid-June to give them through June to the end of August to do what they need to do to produce those budgets, get the information necessary, have conversations either with boards or vendor partners regarding the outlook of spending that you all have. So it is certainly a big process. And for some of our associations that are also conducting ARC inspections at that time, the manager is balancing normal operations, ARC inspections, and producing those budgets. So that's why we try to give a little bit of a wiggle room for our managers to get that done. We do understand that boards want to get those as early as possible so they can start making decisions and take in that information. But certainly we want to make sure that you have a good foundation. Now, let's talk about the board's role. For our boards out there, you all have ceded over to management through your contract, the production of these financial statements. Take in money, pay bills, track where that money is going, provide us with a budget that has analysis. But for the board of directors, I want to lean into the fiduciary responsibility. So your charge as board members is to safeguard the association's financial health. And that is achieved by diving into those financial statements, having an understanding of the fiscal position the association is in. Typically, the treasurer, as the chief financial officer, leads that oversight efforts, but certainly all board members need to support their association's treasurer in asking questions, taking a look at items that are in the financials, being present during those financial statement reports that are done by the treasurer in some associations, to get into the mix with them because it's quite a bit of information. And as you all are volunteers, it certainly helps to have multiple eyes on those statements, diving into the information. Your treasurer also will typically serve as the liaison with management on questions. So they're typically the first stop for them is to talk to the community manager. The community manager is getting those financials, they are receiving them, they should be familiar, they should be able to explain variances, talk about the balance. If they are in need of support, they are the ones who will work with the different departments that we have in order to get questions, or maybe they need to set up a call perhaps with Majerle to go over some information. But we'd recommend starting with the community manager with those questions, let them work on your behalf to gather that information. Your treasurer is also going to be the board's liaison with respect to your auditor. At some point, we turn over the books, we work with the auditor, we may answer questions regarding our internal processes, but the auditor may want to speak with the board of directors in terms of what's going on with the association, what is your feeling in terms of management's role, asking questions about transactions to make sure that you are producing a clean audit. And as I mentioned before, during board meetings, the treasurer certainly is the one who's translating that financial data into clear insights and making sure that you guys have an understanding of variances, what your cash position is. And that also is helpful, having that public segment to the membership so they can get an understanding of where the association is fiscally and also answer any questions that they have. But it all starts with the budget. And I want to kind of get back to the start before we dive into the records, which is, in my view, the budget is the beginning of all of it. And it is the chance for the association to really take the highest level macro view of what is going on, where you want to go, are we achieving our goals, what are those CapEx projects? Because at the end of the day, financial statements aren't in and of themselves anything more than a tracking system. It is benchmarking your performance against something. That something is your budget. So the financial statements are only as useful as the budget which they are based on. So that way you not only get a true understanding of the tally of expenses that you have, but are you in line with the larger strategic plan of where you're trying to go? And if you are slightly off path, do you have an understanding of why you are off path and what you need to do to get back on path? Or is it acceptable given that these are live entities, it's a live building, it's a live site, which is going to require things that happen that we may not be aware of and we need to react to. Is that acceptable because we're meeting the overall goal? What I would tell you is this, before we get into money in motion later on, I would keep in mind that you are playing a forever game. And what I mean by that is that the end goal for the association is not necessarily purely on savings. It is something that we focus on. It is when we look at, are we spending dollars? Are we getting the most yield? But at the end of the day, the higher purpose in terms of preserving and protecting the association's assets is the enhancement of property values. The payout for each individual member is that the assessments that they are paying into are yielding a property that will benefit them at resale so that they can command a higher dollar value than what they purchased the property for, put a little change in their pocket, upgrade their home, move on. We are in a stewardship, not only with management, but with the larger association. So tracking things in terms of individual months are great. Tracking things in terms of individual years is fantastic. But keep in mind that the horizons that you all have in terms of how you are conducting the financials is a forever game with a larger sense of the individual's ability to pull out from the association and gain more money than they originally got in. That is through housing. Now, getting back a little bit on subject, one of the financial foundations that you will start with your budget is not only just the dollars and cents that goes into the individual line items, but what are those line items actually, what are those actual line items that we have? What are we measuring things for? That's what we call a chart of accounts. And as you can see here from the sample budget that we have, the chart of accounts is basically an index of all the financial accounts in the general ledger. This is used as an organizing tool to distinguish what items are income, what items are expenses, and then breaking those down further into what are those particular categories of incomes and expenses. From there, you have the ability to then set those amounts that you're looking to budget and then track those. So for boards, I want you, as you go into next year's budget cycle, to not only look at the figures that you have, but are those chart of accounts accurate to what you're looking to measure? Do you want to consolidate? Do you want to expand? My best practice is always to provide individual line items as best as possible. The most dangerous line item in the world is building maintenance for our condo associations out there. Building maintenance is just a melee of data and information. You want to break those out in terms of plumbing expenses, electrical repairs, carpentry or general building repairs that may be carpentry or non MEP. And by MEP, I mean mechanical, electrical, plumbing style trades. If you have a contract for landscape services, for example, you should have a repair and maintenance line item for non-contractual landscape repairs or site repairs. So matching each of your recurring service contracts with a repair and maintenance line item, and also looking to provide some level of specificity with respect to what it is that you're tracking. Because as all of you are volunteers, going back, having to dig through the financial statements certainly can be laborious. It can also be, we will do it for you, certainly, but that also can take some time to get those answers. So we look to the boards in terms of helping to provide a little bit more of a breakdown of a chart of accounts. We can always provide you with examples. We will always come with recommendations. The one thing we can't do is approve it. So certainly if we're seeing things clustered up, we will have that conversation, but certainly encourage you all to not necessarily dice it too thin and get very, very specific lighting in the front entry or lighting on a particular street, but looking at some of the main component systems that you have, breaking those out so that way you can track the trends. Because again, when we get later into this program, what this whole process is about is being able to, as a management tool, is being able to spot trends in your spending, recognize what those trends are quickly, have answers as soon as possible so the board can take the necessary action to either A, understand that this is what we have to deal with right now because the situation has changed or there has been a repair item that certainly was unforeseen, or yeah, we're tracking right where we need to go. There's not a problem. We know that things are moving along. Michelle, before I get off of this particular side and set you up for the financial statements, anything you want to add to the chart of accounts, the financial foundation as we talked about?
No, I mean, most are very similar from one association to the other. There are caveats, of course. Um, and really it's just preference as far as how general and how detailed you want to go with those expenses. But like you mentioned too, you don't want to go too specific because that gets a little tedious. But for the most part, they're um, pretty common, like well, pretty much the same from community to community, really. With like I said, with a few caveats, but this is really what's going to drive your financial statements and really going to identify the income and the expenses that you're going to see.
Appreciate that, Michelle. And before we move on in the slide, just to tee it up, this chart of accounts becomes the baseline of the income and expense statement. So these chart of accounts that you have, these general ledger lines that you are funding will then be transitioned into the income and expense statement where you're going to see your actuals versus the budget to give you an idea of that variance. So all of this ties together with you with you all. And for one of the questions that I saw briefly, since we're on the topic, we will provide you with recommendations for new associations that have joined us. Typically, what we'll do is a GL mapping. So, certainly different management companies may have a different style or different names for the general ledger categories that make up these chart of accounts. What we try to do is import that data, give you an understanding of what we think is a like account, and then get the board's approval typically. That's a newer procedure that Michelle and I have instituted since coming in 2024, but we want to unify that information so you can so you can follow that transaction. Let's move on to financial statements. And Michelle, I'm going to turn this over to you. Feel free to jump out advanced slide, but we're going to kick things off, of course, with the balance sheet. Michelle?
All right, thank you. Yes, so the purpose of this is just to get you all familiar with the core financial statements and the reports that you'll see in your financial packages each month. The goal here is just to help you understand what the documents are and also how they support your fiduciary responsibility to the association and its members. As board members, you are responsible for safeguarding the association's assets and ensuring that the assessments are properly collected, approving expenses, maintaining financial transparency. And the financial statements that we're about to look at are the tools that allow you to do that effectively. The balance sheet, a lot of people tend to overlook this. And in my opinion, this is one of the most important things that you really need to pay attention to. And not just in community associations, everywhere I've ever worked, people tend to overlook the balance sheet. And it is very, very important to keep your eye on it because this is what really gives you a snapshot of the association's financial position. And it's at a specific point in time. So you're usually going to see it as of the last day of the month or the reporting period. And it answers the question, what does the association own? What does it owe? And what's left over? So you'll see here the first up at the top, you can see the reporting period. So it's generally the end of the month. The first section that you'll see is the assets. This is where you're going to see your cash in the operating and the reserve accounts, any accounts receivable if you're doing accrual, and then any unpaid homeowner assessments or prepaid expenses also. Again, that's with accrual. The second section, if you'll move forward, Jason, is the liabilities. And that will be in the middle of the page. These are the amounts the association owes, such as unpaid vendor bills or prepaid homeowner assessments. So for an accrual basis, you'll see accounts payable, which is what the association owes to its vendors at that time, or you'll see prepaid assessments from homeowners that we've collected before they're due, if you're on a cash basis. The final section is going to be the equity section. This represents the association's net worth. It includes operating and reserve fund balances. So for a community association, you'll typically see separate columns for operating and reserve funds, which is what Jason mentioned earlier with the fund accounting. And as board members, you should review the balance sheet to confirm that cash balance is aligned with expectations and that the reserves are intact and properly funded. You'll see later in here, we also include a reconciliation report that it will tie to this balance sheet as well as the bank statements. You can advance slide, Jason.
Michelle, before we do that, just wanted to point out to go back to the comments that we had on fund accounting. What board members here will see is that you have this first category that is operating, and then you have a second category which is reserves. And then you're getting that total balance. So the entire amount of cash that you all have, in terms of if you put all the money on a desk before me, which I do not recommend, what would that amount be? You're going to go all the way over to total, and you're going to look at this in this particular sample, 597,000. That is the total amount of cash for the association. Part of the fund accounting method is really just a presentation breakdown. So we have a column that's specifically for operating, that's looking at the cash funds that you have. And you're going to come here to that first part that says operating accounts to see how much total operating cash you have. And then the second column, you're going to see reserve accounts. Now, for this particular association that we have, they have what's called an operating reserve. In the state of Maryland and other jurisdictions, some associations are pretty much barred, and it is very much frowned on to take any money out of your reserve to pay for overages. Some of you are going to have some snow bills that you're going to need to talk about from this last storm. And the associations should not be taking funds from their reserves in order to pay for those. Now, in practicality, some associations do. And what they'll typically do is some type of loan line to the reserves. We do not recommend that as best practice, but certainly bills have to be paid in order to keep services moving. So some associations may develop what's called an operating reserve, which is the ability for them to put excess funds away. We'll talk a little bit about that in best practices, but putting excess funds away, and they can draw from those for operating overages. Best analogy I can give you is some large Fortune 500 companies will reserve for legal expenses. So they might have $1 million just sitting in the bank that's separate from their capital investments or other type of items that is available to draw down from should they get into a big, heavy legal fight and they need to have funds available. So certainly as you're starting to look at your finances, you can reserve for operating contingencies, but we do want to separate those. So that's the first part of this reserve fund method the funding method that we talked about earlier, where you're seeing that separation in the presentation of your balance sheets. But going back, and I'll advance slide after this, Michelle, going back, that total dollar amount you're going to see under total assets between that solid line and then the double line underneath all the way over for total. That's going to show you the cumulative balance for your operating, for your reserves, and then how much money you have in total. And I saw a question about the number amount that we should have in operating reserves. Get to that question later on in the program. Let's move on to income statement, income and expense statement, profit and loss, many names. Michelle, back over to you.
Yes, so I was going to point out that the income statement is the same as a profit and loss statement. This one is for a period of time, whereas the balance sheet is a particular day. So you will generally see in your financial statements, it will be for 1 month. Ours have the current period, which is the current month that we're reporting on, as well as year to date. And the year to date will be your association's fiscal year. So if you are on a calendar year, it will be January to December. If you are July through June, it will show those figures on your year to date. And so this will compare the actual expenses to the budget. So you'll see the variances on this statement for the current period as well as the year to date. And so where this kind of gets a little bit tricky is for cash accounting, which most of our associations are on. Like Jason mentioned earlier, because cash accounting is based on when expenses are paid and income is received, sometimes you'll see maybe we got a trash bill late the prior month, so we paid it on the first of the month, and then we got the next one and we paid it on the 30th. So you're going to see an overage in your expenses of 1 month, but then the next month you're going to see a zero. So the year-to-date figures are very important when you look through this because they will give you a better picture. If you are significantly under budget for something that you should be paying monthly, it could be a sign that maybe we're not receiving the bills, or there could be a bigger problem that needs to be addressed. So it's very important to look through your income statement. The first section is always going to be your income. This is going to be where your homeowner assessments, late fees, interest income, any other charges that your association bills for, clubhouse rentals, anything like that. You're going to see at the top, you're going to see what we collected versus what was budgeted for that period and the year. And below that, you're going to see your expenses. So usually it'll be your professional fees, then your utilities, any repairs and maintenance, and then usually your contract services are towards the bottom. again, it's very important to look at these, especially like contract services or utilities, because you can verify that the bills have been received, that they've been paid, and we can combat any issues as long as everybody's putting their eyes on this. There are, as Jason mentioned, it depends on if you're using cash basis or accrual accounting is going to determine how you're going to read these. I mentioned with cash, you can see an overage. Accrual, you're generally not going to see much variance because it's recording the income based on what we have assessed to your homeowners. And the expenses are going to show whatever we're expecting to receive for the bill. So if the monthly bill is $300, you're going to see $300 regardless of whether it's been paid. So that's why I said earlier, sometimes it's a little bit easier to follow a cash basis statement, just because it's a little easier to know the actual cash that's come in and cash that's gone out. There are some governing documents that require like modified accrual accounting. And so unless the board chooses to vote to do different accounting, that's why a lot of them, the ones that do modified accrual is generally because it's in the governing documents. Why this matters to the board. Like I said, if you're on a cash basis, you must look carefully at the balance sheet and the aged receivables report to understand if you have any unpaid assessments or unpaid bills. If you're on accrual or modified accrual, your income statement will more accurately reflect the financial performance, but not necessarily the cash flow. Regardless of the method, your responsibility is to review variances between actual and budgeted amounts and ask questions when something seems unusual. And this is also too where you can find, the other thing I'd point out is you can also generally see if something's been misclassified. If you see something in a line item where nothing's budgeted, it could be just that it was recorded incorrectly and we need to go back and reclassify it. And it's easier to catch that now in that when that reporting period is just passed, as opposed to going back, January of the following year and trying to correct it for January of the previous year. Jason, you can move ahead unless you have anything to add. All right, so next is the general ledger. The general ledger is the detailed record of every financial transaction posted during the month. Think of it as the association's financial diary, essentially. Every assessment that was billed, invoices paid, bank fees, reserve transfers, everything is recorded here. And while board members don't need to review every line item monthly, the general ledger provides the transparency and serves as your audit trail. If you have questions about a specific expense or account balance, this is where the detail lives. And honestly, I do recommend to the board to review this every month, because this is, again, another very useful tool to find out if something has been misclassified. Maybe the water was recorded as trash. When I'm reviewing the financial statements, I always look at this, because if you see your WSSC bill in the trash section, you know that something is wrong. And it's just an easy way to identify that. You can move ahead. The next is the aged receivables report. I know some like to look at this and some don't like to look at this. But this will identify the owners that are delinquent on their dues. Our report breaks down current balances, 30, 60, 90-day periods. The total of these outstanding fees appear on the balance sheet as an asset under accounts receivable. And it'll change month to month. It'll only include the principal balance and HOA imposed late fees in its calculation. And also too, this is where you can see in this particular example, the highlighted in yellow means that it's either a previous owner. Well, it is a previous owner if it's highlighted in yellow, but it'll also say on the upper right-hand side if maybe they're in collections or whatever their collection status is. So whether it's just late or they've been sent a warning letter, or they're in collections with an attorney, you will see all of that on here. And as a board, you should monitor the delinquency trends. High delinquency impacts the cash flow and the association's ability to meet its obligation. And this report helps to ensure that your collection policy is being followed consistently and fairly.
Michelle, one thing I want to linger on is
Sure.
the last line that it will change month to month, only including the principal balance and HOA imposed late fees in the calculation. So for most of our associations who have a pretty set collections policy, what ends up occurring is that once an account leaves management and is referred to the attorney, the charges that are incurred for legal expenses that can, and that's a key word, can be charged back to the particular homeowner, will no longer appear on the age receivables report. We don't have visibility on what legal charges a particular attorney is applying to those accounts. That's where your collection status report comes in. So, as many of you will see, and you should also be getting them in your monthly management reports. Please talk to your manager if you're not. But we upload your collection status report to the board portal, and Shannon, who's in our accounting department, will provide a cover summary. And that cover summary looks at the status of where the account is, any recommendations that we have. That's the cover sheet. When you dive deeper into your attorney's report, that's where you should start to be able to pull out the idea of charges or actions, if not actions with charges, as to what is the history that's occurring. And that's where, until that account comes back to us, if you're on deferred billing with your attorney, you may not have every single visibility of what those potential charges are. That's something that we can work with the attorney on to get that visibility. If you are not on deferred billing, you're going to see that in your administrative fees in the income and expense statement as to what those legal charges are. And you can invoice, we'll talk about invoices later on. You can reference the invoices for there, but this is purely on balances, late fees. It's just the principal amount that you as the association can apply, not the cost for actually going through collections. Wanted to mention that. Michelle, any further comment on that, or you want to advance to prepaid report?
You can advance. So the prepaid report is basically the opposite of the delinquency report. It displays all of the homeowners who have credits on their account. It ties directly to the balance sheet line item, the prepaid assessments under the liabilities. And while the association has collected, the advance means an owner can recall their credit. So it's always a liability if someone prepays, because technically, if they want a refund, you have to give it back to them. The funds are liability on the balance sheet because they represent money collected for future periods. And reviewing this report ensures that credits are applied properly and that the association is not overstating their income. So that's why this is useful as well. You can move forward, Jason. Next is the cash disbursements. This is very similar to your general ledger, but this is only pertaining to the actual cash disbursements out of the bank accounts. So it looks very similar, but it just organizes the invoices by who got paid, what the check numbers were, what the dates were. It's essentially a glorified checkbook. This is what your all the expenses that were paid and when and what the balances were. This will include, all of your vendor payments, insurance premiums, even reserve expenditures. You will see management fees, and it is critical for board oversight because it allows you to confirm that the payments are authorized, that they're coded properly, and with consistent contracts and approved projects. Many boards formally ratify these disbursements during meetings. But this is just another way to promote transparency. Every management company should be supplying this to you because you need to know where your money is going. And it should be clear and always authorized, obviously. But you can move ahead, Jason. So the reconciliation report you will find usually at the end of the reports that we supply within the financial packet. And I mentioned this earlier. This will tie to your balance sheet. So this is going to identify the starting balance, any outstanding checks or deposits, and what the ledger balance is compared to the bank balance. And so if anything's out of balance, it'll be bright red, and it will flag you. Um, each month, the bank accounts, both operating and reserve, are reconciled. Um, and it just means that the association's internal records are matching the bank statements. The purpose of this is to confirm that all transactions cleared properly, that no unauthorized transactions occurred, and that the ending balances match the balance sheet. It's a key internal control and an important safeguard against errors or fraud. Another thing that I always look at too is, if there's a check that's been uncleared for 2 or 3 months, then there's probably an issue there. Either the vendor didn't receive the payment, maybe it was marked as auto pay and the account was not on auto pay, or WSOC is famous for having the account on auto pay and not taking the payment. So it's a great way to easily look to see if there might be an issue there. Um, Outstanding payments for too long is a problem. And if you show a deposit that's outstanding, you need to research that as well. But this is just a very easy way to identify any issues. All right, you can move ahead, Jason. And last but not least, invoices. So the invoices are in the back of your financial packet. You should have every invoice that was paid during the reporting period. And it just provides an extra layer of transparency for the board. And the amounts should match, the invoice numbers should match. And if there's ever any question as to what is on the general ledger, you can always go back and see the detail for that invoice in your packet. This is very useful for auditors, for the board to go back and research. And the things that we look for before we pay these invoices is, make sure that they haven't been paid before, obviously, that we're coding them properly, that they are compliant with the contract, and if the board has a threshold for approvals, that we get those approvals before they're paid. And the invoices just provide the documentation behind the numbers you see on the income statement and the cash disbursement report. Strong invoice review practices protect the association and demonstrate responsible governance. So, and I think that is the last one before the financial FAQs, correct, Jason?
Mm-hmm. Correct. And I can take that, Michelle. So
Okay.
just a little bit of a recap for you all, and then we can recap it also one more time in terms of those. So a lot of times you'll have clients who have questions such as, what's the cash position? That's what you're going to see with the balance sheet. That's the official figures on the current account balances, cash on hand. Boards will ask, are we on budget? Your income and expense statement is going to provide you with that answer. Looking at the total expenses that you have against the total actual expenses that you have in both the the particular month that we're talking about and reporting for, as well as year-to-date figures. Why are we over budget? This is where we start to bring items together. So looking at the income and expense statement as identifying the variances in particular line items, taking a step further to look at the general ledger report to see what charges made up those particular items that may have caused you to go over budget or just general costs in general. And then the proof in the pudding is the actual invoices to take it a step further to see, well, what occurred that made up those charges that then caused us to go. So your financial statements are giving you a layered approach in terms of further and further deep diving into what's happening with your finances. Did everyone get paid? That's going to be your age receivables report and a breakdown total outstanding did everyone pay? Excuse me. That's your age receivables report with the outstanding assessments broken down 30, 60, 90 days. Why has the bill not been paid? Most of our clients are on a cash method. And as we discussed, invoices are recorded when paid, not when incurred. If no bill has been received at the time that the financial statements are produced, nothing is recorded. So it's not that we haven't paid a bill, it's that we're waiting for that particular vendor to actually invoice us. Some associations may use smaller vendors, which is great because supporting small business is what we're about. We're a small business, and they may have an accounting staff of one. So some of those invoices might be a little tardy, and thus you're going to see some fluctuations. I need a copy of an older financial package. Happy to report that all your financial statements are uploaded on the board's sync portal and available for you all at any time. Let's talk about money in motion. And again, recapping some of those items, that balance sheet is a summary of your fiscal position. Income and expense statement is comparing each of those line items month and year to date. Age receivables is giving you that breakdown. Age payables is tracking your bills. General ledger is giving you the detail. Your reconciliation reports is, like Michelle talked about, that internal auditing record to demonstrate how we came up with the balances that we're producing. And then your invoices, again, provide further reference. Now, as we talk about money in motion, we also want to focus on putting this data to work. And the two items that, or two concepts that I would start with is financial analysis and financial forecasting. Financial analysis is summarizing what is the current fiscal picture and how it was created. So this is the very flat, down to earth. Here's what we have. Here's what's been incurred. Here's what's happened. Financial forecasting is used to take those statements and discover trends that you have and make predictions about future fiscal health. A lot of this is what you all do in your budget, in the budget sessions that you have, looking at the past financial data and coming to an understanding as to what actually is happening with the trends that we're seeing and what do we need to do to either adjust, change, correct, so on and so forth. Let's dive a little bit more into financial analysis and where do you get started? So the primary question here is, how are we doing? How are we, what's our fiscal position, Jason? How are we performing? Let me give you some initial steps because I know this is a lot of information and you may be thinking to yourself, well, where do I even begin? And are you sending this recording out, Jason? You better do it. Yes, I will. We'll condense it down most likely to just the financial statement so you can rewatch that as we're hitting the hour. But let me give you some tips in terms of where you can start. First, review your assets. Go to the balance sheet section, as Michelle mentioned, and look at your cash position. That's going to be the index, if you will, of are you keeping in line with the expenses that you're incurring? Do you feel that you have enough money in the bank? Are those reserve contributions continuing to be made? They will be, but certainly want to verify that. You want to go to the very bottom of your income and expense statement. I read income and expense statements from the bottom up because part of this, and we'll talk a little bit in terms of prioritizing information, but what you want to do is just begin from a point of, are we over budget or not? Doesn't mean you shouldn't look into the greater details of the financials, but as you all are reconciling this between making dinner, resting from work, trying to get maybe that late night email out for your job and everything else, a great way to start is to start at the bottom and look at the performance both month to date and year to date and look at the variance. And then you begin to move up and start to look at the categories that you have. If we go back to one of the earlier slides for the income and expense statement, what you'll notice is that you see utilities, taxes, administrative expenses. And then you're going to see a line here for total administrative expensive, total utilities. In this particular scenario, we see that utilities for this particular association are over by $1,441. That's something I'm going to pull out and go, okay, let me dive in further from that. That should have an impact too on the overall bottom total balance. And then I can move up to that line item and see, well, it's coming from electricity because electricity was high. Might have been double billed in that month and two bills converged at once. But starting from the bottom up allows you to identify, do we have something that we need to dive further into? And then moving up the categories allow you to focus in on the categories that are not performing towards budget, which then begins to make this a little bit more digestible for you all. You're going to review the aged owner balance report to get a house by house understanding of the outstanding assessment picture. Part of the reason why I blurred out or you didn't see those names with addresses and homeowners is that we wanted to protect those identities. But it's, if you look at yours, you're going to see a house by house breakdown in terms of who are those accounts, what homeowners are we talking about, what is the total amount they owe to the association, and how is that money broken up, so you can identify exactly who has not been paying, and then we can have more targeted conversations of comparing the collection status report that you all are receiving from your attorney against actions that they're taking, or are we on the line in terms of how the association wants to refer accounts over to the attorney, or are there other items? Michelle, I saw that you got off mute. Just want to pause if you want to get in there on this one.
Yeah, the only other thing I wanted to add to that that I forgot to mention was with the aged owner balance reports. You actually, as a board member on your board portal, have real-time access to those figures. So under the board section of your login, there's a few different options, and you can look at them in a few different layouts. But you can see the delinquency, you can see the aged owner balance, you can see your bank's bank account balances, all of those things. But those are real time versus your financial reports, which are, a little bit delayed. So I just wanted to throw that out there.
I appreciate that. We'll always do a plug for our owner portal. That's under board overview, and you'll see that in terms of features. You'll also see, Michelle, I think we had announced it before, that we do have the account balances now available for you to see. Some of our owners out, some of our boards out there have asked for visibility on bank accounts. That's something that we can have conversations about how to set you up for that. But now we have the feature where we've enabled that for all of our associations. I believe those are reconciled daily, Michelle, if I'm
Yes,
correct.
that's correct.
Yeah, so those are reconciled daily. So every day, if you go down, you look at bank balances, you'll be able to see how much money is in your account. You won't have the breakdown of transactions, unfortunately, but you will be able to see the total dollar amount that is in your account at any given time. And as was mentioned before, the reconciliation report that Michelle was talking about also then moves to the bank account statements. So just a reminder on that, we do include those bank account statements in our financial packages for extra visibility. Now let's deep dive a little bit into financial analysis. And I want to talk about some best practices here. First is that establish focus time to review quarterly performance, not just month-to-month figures. This is a better way for the board to spot trends. One individual financial statement is going to give you a lot of information, but again, it is just snapshots in a moment of time that may not flush out, especially for those using cash. What is the actual truth of where the association is headed? So while you certainly should have your treasurer provide just a quick summary at a board meeting. Hey guys, we have X amount of money in our operating, X amount of money in our reserves. I took a look at the income and expense statement. Variances were not material. You'll see me have a conversation about that a little bit later. Variances were not material. Things are looking good. I'm satisfied. No questions. That's great. But to spot trends and begin to tee up what we'll talk about in financial forecasting, I would recommend more focused time on quarterly performance. Again, we operate Majerle Management as a business. This week, Michelle, Josh, and I are going to have an offsite, and we're going to dedicate a portion of our offsite huddle to talking about Majerle's financial performance at the end of last year. So we can spot trends. We can understand where revenue opportunities are. We can see where our expenses were. You guys are operating a business. It very much feels like running a town, but certainly you guys are operating a business. So having focus time for the principals to really deep dive into the information, understand the trends that are happening to see if you're on track, off track, is going to give you the visibility and the space, carving out space for yourselves in order to understand what that fiscal position is. Highly recommend that as a best practice. You want to aim, and I saw a few of these questions come up, you want to aim to maintain about 2 to 3 months of total operating expenses in your operating account. Anything over that is where I would get into excess. And those excess funds then can be candidates to be transferred over to a reserves. As one board member was asking, maybe that's something that you transfer over into an operating contingency account for yourself. But in terms of cash on hand, certainly we don't want to get the account down to just $0. Money moves a little bit more wild than that, but you want to have certainly a little bit of a cushion. 2 to 3 months of operating expenses is a good target to then say, okay, we have excess cash after that. That's something that you should look at actually right now. You guys can have that conversation as you're starting to receive into your financial statements and your January statements to see, hey, do we want to have a conversation about transferring excess over, maybe kick off an operating reserve account, transfer that to reserves to make up some deficits that you all may have, or to replenish spending that maybe was taken out for loan purposes. Um, next is going to be what we call material. Overspending is not great, but is also not always the end of the world. And the reason being is that what is that overspending for? So, for the board of directors, in terms of consuming information, I would encourage you all to set an internal trigger for what you all feel is a material variance to then have a much deep dive discussion. $100 over budget in your utilities expense, I would not necessarily deep dive into that. $1,000 in a particular line item, that's worth a discussion on a per month basis. On a quarterly basis, if you're going back to the first suggestion, which is to have a little bit of time to go into deep dive, I would look at about 10% of your budgeted spend. If you're going over 10% of your budgeted spend in a particular line item on a quarterly basis, that's something that you should dive into to have a conversation and say, all right, do we have a full understanding of what's causing that? Hey, community manager, would you be able to brief us at our next meeting, take an action to dive into that so we can have an understanding? Board members, let's look at that general ledger report to not only identify through the income and expense statement what periods we saw those overages, but make sure we're briefed as well. The last thing I would say is that you want to link your financial results to your strategic plan, not just your budget performance. And that goes back to something that I said, which is that you're playing a forever game when it comes to the association. And you're looking at investments. This is a forever institution that should outlast numerous boards. So the investments that we make, certainly budget performance and associations that might have collection issues, is something that you have to battle on a day-to-day basis. But you have to also look at that through the other metrics of, are we meeting the strategic objectives that we have? Are we enhancing the clubhouse? Are we doing beautification projects that are attracting curb appeal that's going to get top dollar for our homeowners when they bring their homes on the market, or maybe if I bring my home on the market as an individual board member? So looking at just pure budget performance is a great start and something to help you understand where you are fiscally and holding your vendors, including management, accountable. But I would encourage you to broaden that out to this larger strategic vision. For those who may have not seen it, please check out the quarterly client note that we issued when it talks about strategic planning for some tips and tricks on what you can be doing in the early parts of the year to start having that conversation on where you want to go. As for some of you that are new clients, that I'm so pleased that you joined us. We had a conversation in the sales process about defining momentum. This is where we get back on an annual basis to understanding, what does success look like? What are the things we want management to do that we also want to accomplish? Because if we're all moving in a forward direction, have a key understanding of the strategic plan, we're all feeling that momentum. Let's talk about, make sure I didn't overwrite it. Let's talk about financial forecasting, which is essentially fortune telling, if you will, in my opinion. And that is the question of where are we going? And I'm going to read from my prepared remarks here that I have, which is that, let me start by saying this, is that I think in business and in financial management, we often think through a mentality of deterministic. And what I mean by that is that there is an assumption somehow that past performance is going to perfectly calibrate with the road ahead. I can tell you that is not true. And the reason being is that you have a live organism. If it's a condo building, for some of our condo clients out there, it is amazing the things that go leak, boom, and explode in the middle of the night that may be happening right now. Don't want to scare you, but it's things that haven't, it's the pot on the back of the stove that is slowly boiling because there are things happening behind the walls that we cannot see, we cannot test for. For for our HOAs out there, the change in membership, a change in the homeowner base, and all of a sudden you lose 10% of the members to new 10%, you're rolling the dice every time there's a resale as to is this a person who's going to be a good neighbor and pay their HOA fees on time. You have a live ball situation and weird things happen in property management. I can tell you that with nearly 20 years. So the strategies that you are employing and how you are gauging performance need to be nimble, they need to be flexible, because the moment that you are meeting will constantly shift under you. The best advice I could give you is to not have everything hinge on it going according to plan perfectly. Give yourself wiggle room, maybe some extra funds that you have inside of GLs that can balance out overspending. Maybe looking to push 3 months of operating versus just 2 months of operating, but giving yourself a little bit of space to incur the unknown and budgeting for the unknown is paramount. So as we talk about financial forecasting, this is done both on an annual basis when you're having that particular strategy meeting, or better yet, you're having that discussion at your budget process. What we teach our managers is that the budget meeting is the time to look at everything, dust off the reserve report, talk to clients about commitments for CapEx projects in the upcoming year so we can maximize the winter. Get the bigger discussion down of where we're going so we can budget for the unexpected and also make sure that we're adhering to where we're going for the baseline operational. You also want to have a discussion amongst yourselves about what is that 3 to 5 year outlook. What are the big ticket items that are coming down the line, and how does that fit into the association's fiscal picture? I would also tell you that we are not isolated from the greater macroeconomic environment. A lot of you who may be watching the news are hearing conversations about affordability. I'm not getting political here, but certainly there are individuals in our area that might be facing some economic hardships. So modeling delinquency spikes during economic downturns is something that the board needs to consider when it's conducting its budget. I will tell you that the truth of the matter is, homeowners who are delinquent are not bad people. They're in a jam. I remember my mother who used to say, "Oh my God, if I'll get $50 to death one more time, Jason, I'm going to lose it." And what they do is they pay their creditors in terms of who's going after them. So is it right? No. But if we recognize that people are either a professional debtors, which are the minority, I will tell you a lot of them are the minority. The majority of the people are individuals who have fallen behind, may have lost their job, or have to pay between their mortgage, a healthcare bill, or their assessment. They choose to gamble with us. The best way to you to protect that is, one, a strong collections policy and making sure people understand that certainly this debt must be taken seriously, but it's also the association giving itself wiggle room in terms of, we're going to put a baseline 3 or 5% delinquency inside of our budget, even if all of our homeowners pay on time, because past data does not yield future performance. We have to have a little bit of a wild factor in there in order to hedge your bets. In terms of more fortune telling that you can do, you want to seek to bend the cost curve by rewarding quality vendors with multi-year contracts. If you have a landscaper who's killing it, the best advice I can give you is to have a conversation about getting a 3-year deal with that landscaper. Talk to your fellow board members around May in terms of who you're interested in bidding out, and give that advice to your manager. And if you have vendors who are doing a good job, maybe you don't bid them out. Maybe you go to them and say, "Hey, could you do a 3-year deal with us?" That gives us a tremendous amount of negotiating power in order to say, "Hey, Mr. Landscaper, we have a client who's willing to sign up for a 3-year deal. Don't recommend 5, but 3-year deals are pretty good. Would you give us a beat on year 2 because you got it locked in?" That's giving you greater predictability in terms of what your expenses are. That's giving us enhanced negotiating power in terms of getting a better deal, and it's slowly beginning to bend the cost curve. Labor costs go up every year. Materials costs will fluctuate based on macroeconomic factors. I just did a whole designation where I wrote a paper. And yeah, tariffs will impact the ability for you to repair certainly interior amenities that you have, because material costs go up if they're outside of the country, or if they have submaterials that make them up there coming in the country. It's all interconnected. Apply realistic inflation assumptions to items like utilities and insurance. I live in DC. I cannot tell you if I had to pick myself up off the floor a couple of times based on my utility and my water bill. They out to get me. Inflation is going up. Utilities are increasing baseline prices. These are the things that are going to sneak up on you. So giving yourself a little bit of wiggle room by applying inflationary assumptions, that's something that we're going to start with, but certainly something to keep in mind. Schedule a focused mid-year financial deep dive when you get your June financials. That's going to give you the ability to really start to look at whether or not what we've seen in terms of the performance so far is something that's on track or off track. And if it's on track, what's the likelihood that it's going to remain on track? If it's off track, why is it off track? Do we understand whether or not we're getting results based on the spending that we have because things are getting repaired and stuff's just going wrong? Or is there something more structural going on that we need to dive into? At the end of the day, the financial statements are a tremendous tool for you all to get a real understanding of the heartbeat of the association's fiscal position. Our job is to give you the data to help you walk through it. The one thing we can't do, though, is to make the final decisions. Our job is certainly to give you the recommendations. As I said many times, we're supposed to give you the straight dope in terms of what it takes to run your association. But we look to you as the elected representatives of your individual associations to at times make the hard choices in terms of where you want to spend resources, what you want to cut, dividing things between obligations, needs, and expectations of your members. But we are a part of that. We are your administrative consultant. We are here to help. With that, I want to move into questions that we have. If anybody wants to have a question, I would ask you to just shoot me a message inside of the chat feature and I'll call on you. But I did have one or two items that came up before while we give everybody some time. Michelle, I'm going to ask if you could take this one. One of our board members asked, "What's the purpose of the retained earnings operating?" She's noticing that, I believe, on her balance sheet. Could you talk a little bit about what that item is?
The retained earnings operating is just the net income or loss over the years of the association. It's it's essentially the association's net worth. Um, and it's over a period of time, and it fluctuates from year to year based on the activity of, under budget, over budget. Um, I don't want to say it's not going to really be anything that you need to really analyze from day to day or month to month. Um, but it will show you over time how the association has done as far as budgeting and expenses. Sorry.
No, I appreciate that. Great question. We had another question that came in, which was about the operating. What's your advice on how much an association keep in operating reserves? That's a really great question that we have. So the operating reserve is really going to be one or two things. I would say to kick things off in terms of establishing it, I would look to I would look to transfer what would be excess over 2 to 3 months operating to kind of kick that item off. That'll at least give you some seed money. Really, what you need to do is have kind of a little bit of a conversation regarding what is the exposure that you all have. For this particular board member, she knows I'm talking to her right now. You guys have a lot of asphalt. So one of the things that you might want to look at is an assumption of one-off asphalt repairs that need to be done. Because you all have a lot of asphalt, you also might want to reserve, let's say maybe 15 to 20% of what your snow budget is as a starting point, because the operating reserve should really be what you lean into in order to pay for expenses that are unexpected. So look at establishing that number based off of percentage figures. You might hear me talk about change order allowances when we do CapEx projects, but depending on what you've seen in the past, 20, 15, maybe upwards of 30% of a particular operating budget for those areas, such as in this particular community, but think about your own asphalt, snow removal, tree repairs is a good place to start to say, okay, these are the things that we're identifying. Your manager and, Michelle, I, and Josh believe in a team approach with this. So part of what we're looking to do is talk with the manager. You can bring that question up to your manager closer to the budget. We can assist them. That manager might be able to take it on their own, but certainly we can have a conversation. But percentages of individual line items where you've had past spending is a great way to start. Individual areas where you've had overspending and identifying those is paramount. Appreciate that question. Another one that we have, what can Majerle do to help us lower delinquent HOA fees? What have you done in the past to help communities in this area? Really great question. It is the lifeblood of the association. So my first recommendation is to, one, keep your assessment, your collections policy tight. And what I mean by that is your assessment is due on the 1st, it is late on the 15th, and it is referred to the attorney on the 30th. That really comes in handy if you have something called acceleration. And acceleration is a provision in your governing documents that basically says you miss one payment, everything's due now, the whole balance. And that makes it a little bit more advantageous to go to court when you're looking to get a money judgment against an individual for 1 month's assessment versus a full year's assessment. That's a little bit better balancing act that you have. The other thing that I would recommend is we do have, and this is an upsell. I'll be upfront with you all because it's a cost that you would incur. We do have an outfit called Spurlonga. Spurlonga is a credit reporting agency that we can partner you with, and what they will do is they will pull data from Sync, which is our accounting system, and they will submit that to the credit bureaus. And the credit bureaus will ding people's credit who have not paid their HOA assessment. They will also help people who are paying their assessment on time in order to enhance their position and reward them for being good members of the association. So that's an item that you can look at. I would say that as part of your strategic planning in those early months, as you all are starting to work, come back from the holidays, you're getting into the groove of the year, I would invite your attorney to come to one of your board meetings, have an executive session, and have them go over the collection status report. As for vendor partners out there, certainly recommend have them up front and then open the meeting later, but have them walk you through what actions you're taking and have an understanding of maybe some challenges that they're running into. That can get into, and I'll go a little bit into this question, but Michelle, I want to get you on this one about the the write-off of uncollectible receivables. That could get into a conversation of what is worth continuing to pursue and what do you just need to write off? Because if a homeowner has left, they have moved out of state or they have moved out of country and they owe you $3,000, it might be more beneficial just write that off and move on versus incurring more money, whether you're in deferred billing or not, in order to just save yourself some extra expense, save some funds that you're expending in order to chase after homeowners and go after debt that has a higher level of viability. You'll see those collection status reports will give you recommendations, but we are not lawyers, we are connectors, and the best thing we can do is get you in the room with your attorney and have them walk you through that. Last thing I would say, and then Michelle, I want to turn over you to comment about that also with a question we had about advice on write-offs and uncollectible receivables. I'm skeptical of some of the outfits I've heard out there in terms of non-attorney debt collectors. And the reason being, I had a conversation with a prospect. We were very blessed to get an opportunity for a community Upper Marlboro, and I was chatting with the board president yesterday. And what I was telling her was that sometimes I'm a little hesitant on people basically remixing tried and true methods. So traditional collection agencies at the end of the day still need to get a money judgment against an individual homeowner. They might rearrange the deck in terms of the expenses that you all are incurring, but at the end of the day, they are going to get paid somehow, some way. So getting into the fine detail of those non-traditional methods and understanding what is the money benefit or the money motivation for those outfits in terms of how they are compensating their time is going to give you a glimpse into whether or not that's affordable. But at the end of the day, this is still America. You got to sue people in order to get your claim. Michelle, over to you for comment on that.
I don't have a lot to say other than generally we do not determine when to write things off or when they're uncollectible. We will generally take the recommendation from the attorney and turn that over to the board for approval. Or we may have already discussed it with the board as far as what they're comfortable with and how they would like us to proceed generally in those instances. But I absolutely agree with you. If it's a prior owner, they're gone, the likelihood after the attorney has tried to seek them out that you're going to recoup those funds is generally very small, and you're going to continue to incur bills. So it's probably more advantageous just to write it off. If it's a current homeowner, of course, you want to continue on that path. But we generally default to the collection attorney and their judgment, and we, work with you to determine, next steps.
I'm going to go a little out of order. Mr. Parsons, I see your question, and Reed, I see your question, but I want to touch on Monica's question real quick, which is in the past, I was told some delinquent cases are ruled in favor of homeowners. So what do you recommend? Part of that, and I assume you're talking about the individual homeowner, Monica, I'll give you a moment to clarify. If you're talking about the individual homeowner, that would most likely be done because there was a technicality in either the association's um, collection policy or some technicality between what your governing documents permit and how the case was handled. So we certainly want to be in concert with the association's attorney in terms of making sure we both are recommending that you have a solid collections policy that is written down, that is universally enforceable and is clear, and that's based on the authorities within your governing documents. Most of the cases for HOA should be slam dunks, and you'll win. Typically, you'll win. The problem isn't winning. The problem is getting the money. It's what happens after the gavel falls that ends up being the problem for most associations, which is that it's chasing individuals to to actually stop moving their money around when there's a garnishment order. It's the board saying, you know what, we're going to roll the dice, we're going to foreclose on this particular house. So the judgment only secures your claim. It doesn't actually mean they walk out of court and write you a check. And that's where a lot of work can continue in terms of you going after those homeowners to get the funds that you have. Keep this in mind. The association's governing documents are a contract. It's a contract that I think a lot of us from the board perspective look at to say we are enforcing on the individuals, but individuals can enforce it on the board. So when some boards that we've talked to have said, well, do we really want to go after homeowners? Can we take a beat on some of these cases? Not really, because that can expose you to questions of not uniformly enforcing the governing documents against all homeowners, which then is a breach of your fiduciary responsibility, which is claims of negligence, which gets into a whole mess of a governance aspect. So there's a lot to unpack. It is not an easy win, but it's also a realistic understanding of how to budget effectively to protect yourself from cash flow crunches by either looking to spread some of that cost to the other members. I know that's not fair, but that's something that happens to keep the lights on, literally, at times. And then also leaning into some other methods that we have available. It's an ongoing conversation. Michelle and I are also relooking at collections in terms of what more we can do for you all, but it is a never-ending battle. We hear you. We are working to do what we can for you. We're always happy to unpack what can be effective for you on that. Let me get to a question from Mr. Parsons. He writes, Michelle and Jason, can regular maintenance of capital items such as an entry gate be taken from reserves? I would say if it's regular maintenance, sir, no. Regular maintenance would be something that would just fall into general repairs. Now, let's get a little wonky. Let's say that you have a sophisticated system that provides access control for the entry gate. That box and upgrading that call box system or the components of that is something you could look to put into your reserve study. And when you have these updates, your level 2 reserve study, which is typically done every 3 to 5 years, you may want to break out maybe some of the components. That's a good way to budget for it and make sure you have some cover. But if you're talking about maintenance and regular maintenance, I would say the safe bet would be no. Look at, again, reserve replacements for that. I got another question from Rita. Rita, thank you for this question. The income and expense statement includes expenses. Why is it not called an income and expense statement? Am I missing something? There's a bunch of different names that we have. We refer to it as the income statement. That may be a little bit of my terminology. I apologize. Profit and loss, P&L, income and expense. It's all means the same thing at the end of the day. So your income statement is, again, taking all of those chart of accounts that you've agreed to. It's turning them into those general ledgers, and then it's creating the tracking of the budget amount that you have for each line item into per month and then per year. And I'm happy to do a part 2 of that for you. Next question we have is that, can those losses be written off on a yearly basis? Mr. Smith wrote that for us. I would say that's a conversation that you'd want to have with your attorney. Gerald, I would start by bringing them in and make a determination as to what is the viability of obtaining that, of getting that debt, and then making that conversation. So yes, you have the ability to write that off. I would treat it as a last option, and I would weigh that against foreclosure, to be honest with you, because that's especially if it's an existing homeowner. If it's someone who's left the community, I'd feel a little bit more comfortable dancing with that. But if you have a homeowner who is actually in the community and you're talking about writing off prior debt, I think that gets into some governance messiness in terms of universal enforcement. Michelle, any comment on that in terms of what you've seen from other clients who are wrestling with that with that discussion on write-offs for either prior owners or current owners?
No, I don't have anything to add outside of what you did.
Okay, appreciate that. And the last question, here's another question we have. Is there a way to reward good homeowners? Beautification, Alan, I would say beautification, putting that money towards work. If you have a single family home or townhouse association looking at landscape enhancements, if you are a condo association looking at small renovations, fresh coat of paint in a hallway can do wonders for people's mood. I think that most homeowners want to see their money in motion, and they will, most people are reasonable and they understand that I moved into this condo. I need to pay into my share of what the association is trying to adhere to. Where I think homeowners get frustrated in terms of when they call about you all, when they call about their boards and want to speak to management about what's going on with this association's board, they're looking for action. And we need to help you with those and walk through those actions, get good bids, get good vendors, talk about a strategic plan. But the way to reward them is to see their money in motion, make them feel that we are investing as a collective inside of the property. Because at the end of the day, the game that they're playing is a 10 to maybe, I heard a statistic from, I think it was, oh God, the Zillow, which is that a person will buy a home about every 14 years. So this is not a forever game for them. This is a horizon of 14 to 20 years. They're looking to see what's being done to keep the building up so that when they're ready to draw and move out, they know that their investment's going to yield some results for them. So rewarding homeowners by, I can't give them a discount, but certainly seeing that money in motion is amazing. Will we be able to access the recording somewhere after this? I need to sign off. Can I get a copy of the slide? This is excellent. Where's the slide? Anybody got a slide? Who's going to give me the slide? Yes, everybody. If there are no further questions, I will stop share for a second and I will see everybody's beautiful face. Do not fear, everyone, because yes, these slides will be available for you. What I'm going to do is one, I'm going to condense down this video to the section that was on the financial statements. So that way it's a little bit, we're at roughly an hour and a half, and certainly want to make sure that it's clean because we want to put this on the online so everybody can see it. So I'm going to condense that down. And yes, I will be happy to send out this slide deck presentation for you all so that you can reference it. We want to make sure that you all are getting good information. Something that on two last notes before I end, something that we certainly want to keep from the Chris Majerle years is an investment in training and education, and having you all see that investment in terms of being able to talk about controversial issues to baseline issues is the commitment that we have to you. Michelle, before I close things out, just want to offer any final comments, any clarifications on when to reach out to you or the accounting team?
So one thing I wanted to add, I'm just going to circle back real quick to the operating reserve. One thing I wanted to offer to everyone, because not everyone is aware, um, an option that we have, if you tend to carry quite a bit of funds in your operating account, we can set up, it's called an ICS account, which is an insured cash sweep, and it essentially shadows your operating account. But we can program it to where your operating account can maintain a certain threshold, let's say $50,000, just to make it easy. And then anything over that amount can sweep to the shadow account. And that would essentially be your operating reserve, to make it simple. And then it would be, it's always insured and you can gain a little bit of interest. It's not going to be a whole lot, but it makes it easy and you don't have to worry about doing extra transfers to the reserve or things like that. And if that's something that's interested or that you'd like to know more about, just feel free to reach out to me. I'm happy to talk to you one-on-one about that. They're very easy to set up. There's nothing that you would need to do on your end. I arrange it with the bank. You'll see it on your balance sheet each month, how much is in that operating reserve versus your regular operating account. So I wanted to throw that in there. And then also I just wanted to add that we don't expect you to be accountants. We know you're not accountants. We look at these financial reports every day. You see them probably once a month. So if you have questions, feel free to ask. Like Jason said, if it's something particular on your financial statements, start with your manager. If they don't know, they'll usually reach out to me to get an answer for you. And if it's something more in depth or maybe regarding bank accounts, options there, you can always reach out to me, but I would say start with your manager. I'm always happy to get involved, but just start there. And that's it. That's what I had.
Michelle, I appreciate that. I won't get too preachy, but I will tell you all that it is not always a common occurrence that I get to be in front of 33. At one point, we had 40 of our board members all in one place at one time. And it would be remiss of me if I didn't say thank you all very much for your continued confidence, for your continued partnership, for the collaboration, and more importantly, for your service to your individual communities. It takes viewers like you to make those communities work. And we are tickled, thrilled, honored, humble to represent you all. Myself, Michelle, Josh McNally are partners in this with you all, and we are available for your support. We will always encourage you to work with your manager, but certainly we are avenues and channels for making sure that we're getting the ship in the direction that it needs to go. I'm again just tickled to have so many of you on the call tonight. I thank you for making some time to spend with us. This will not be the last time that you see this mug in front of you all. We want to continue to do more trainings like this on focused topics throughout the year. We are working on the April session for you all, and we'll send out similar notices when we have that topic set and ready to go. So thank you, everybody. I will get slides out before the end of the week. I will start to condense this down and let you know when we have that video available. And last plug, if any of you are around this weekend, there is the CAI, Community Association Institute's annual conference and expo that's being held in downtown DC at the convention center. A great opportunity to meet vendor partners, get seminars and classes. If any of you are interested in attending that, please let us know. We can pass you on that information on how to attend that conference. It's a great opportunity. On behalf of all of us here at our Rockville studios, thank you everybody for coming out tonight. Good night and good luck, and we will see you next time, next program. Take care, everybody. Thank you.
Thank you, everyone.